We're half an hour away from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Your top stories today. Chinese stocks are poised for a big jump following a surge in U.S.-listed shares overnight as top leaders signal bolder economic support next year.
Indeed, the Politburo using its most direct language yet on monetary easing and boosting consumption, as well as pledging a more proactive fiscal policy.
Also ahead on shows, China's launching this anti-monopoly investigation into Nvidia as the tech conflict with the U.S. escalates. Tensions, of course, also extending to drones as Beijing cuts off key supplies to U.S. and also to Europe.
All right, there's really just one game in town for Asian equities this morning, and that is these new stimulus measures or this shift to a more proactive, looser monetary policy front in China. And the market reaction so far, I'm actually a little bit surprised that we're not seeing such a big jump being signalled in futures this morning. But that is the state of play as we look ahead to the open of Hong Kong and mainland China. Of course, you do just see that red line there crossing, futures surging after the latest stimulus announcements. This is the early reaction here that we're seeing. But let's change on, because I think the real guide came in when all of this was being announced, what was happening on Wall Street and the stocks that are listed there as well, because you saw that big jump in the Golden Dragon Index. Names like Alibaba, Tencent rallying more than 7-8%. Here are some of the biggest movers, of course, coming through. Xpeng, Neo. This is also that play, not just about a more loose monetary policy. It's also about that shift. How can we try and actually stimulate forcefully consumption within China? So you're seeing those names that are gaining here off the back. Changing on, it has been also the second order implications as well. You're seeing those moves coming through in commodities this morning, for instance. Iron ore gaining in the broader contract plus the contract here in China. Copper a little bit under pressure but steady to start the day, and also you have seen those gains coming through in the Aussie dollar. Again, a little change at this point in time. What else we're tracking in the session as well is perhaps why China has the reason for these stimulus measures as well, and that also comes down to that relationship between the US and China. And if you take a look at some of those movies in the session so far, we've actually seen a new front, a further escalation of sorts also being opened up, because we do have an investigation from Beijing into China. The question is whether they're exercising too much monopoly power in the market, but do see some of those supplies to Nvidia as well a little bit under pressure so far, Dave?
Oh, yeah. In fact, I'm just looking at just separately so the A50 futures are coming online 6 cents and 1%. To Annabelle's point, maybe slightly underwhelming. What is moving, though, and just pivot this to our viewers right now, is the Chinese 10-year yield is going through the floor right now. We're down about 5 basis points in the early minutes. We're down to about 1.88%. That should be, if not the steepest drop, I'm going to have to check my statistics, going all the way back. In fact, this supersedes, in fact, the drop that we saw back in late September. Anyway, we'll show you that in a moment. But again, this everything rally that we're seeing, maybe particularly onshore, it's worth keeping in mind also in terms of timing. Mainland China was shut, and then a few minutes after that, that's when news broke out of the Politburo. So watch for mainland markets today. In terms of data coming through, November trade numbers are coming through, number one. We could also get credit data to come out as well. This is for the month of November. Watch for those two things very, very closely. Of course, the yuan fixed today, given the rally we've seen in the Chinese currency. And of course, you have this this listing, this trading debut in Hong Kong, Mao Geping, which is a cosmetics maker here in the city. Watch, of course, how that trades. But yeah, all roads lead back to stimulus. And really, the hope is this manages to get over this cornucopia of 5 syllables of cynicism out there.
All right, I can see Steve's counting those syllables on his fingers this morning. Let's get more on this now. Bring in our Chief North Asia correspondent, Stephen Engel. Also joining us this morning is our Chief Economist, or Asia Economist, Chengchi. But Steve, we'll start off with you. Talk us through exactly what was announced overnight.
Sure, I'll try to keep my words less than 5 syllables to keep it simplified. Okay. The Politburo obviously is the top 24-member body of the Communist Party, led by Xi Jinping, of course. They had their closed-door meetings, and they had the statement coming out, waiting for that ahead of the Central Economic Work Conference, which begins tomorrow, which will kind of take the marching orders and flesh out the details. So those details came in that statement that really did set the tone, and that's what the Politburo meeting does. It sets the tone. It doesn't set the specific targets, even though they did talk about growth of around 5% again in 2025, the same as this year. The key was changing the stance on monetary policy and also signaling forceful moves for consumption. So, again, fiscal stimulus is what the market has been waiting for. On the monetary front, moderately loose stance is what they've shifted to after being prudent since 2011. The last time they had a moderately loose monetary policy was during the global financial crisis, basically from November 2008, yes, till about 2010, and then shifted to a prudent monetary policy for the last nearly 14 years. So this is significant, could basically pave the way for a lowering of interest rates. Also, of course, raising that debt to GDP ratio of 3%. That could pave the way for some more, central government borrowing and bond issuances and stabilize the stock market. They could also, of course, do some stock stabilization fund, some property measures. There's all kinds of things. They listed a whole laundry list of the problems in the Chinese economy, and they addressed almost every single one of them. Now we need to flesh out the details in the Central Economic Work Conference, as well as then basically stamped into law at the National People's Congress in March.
Changshu, let me get your reaction. What's new here?
I think this time the signaling effect is very powerful. The statements, as Stephen has already indicated, went beyond the recent statements compared to the September Politburo meeting and a series of briefings after that. So all those messages came out of the previous meetings were already very positive, but this time the statement is even stronger than that. Apart from the stimulus Stephen just talked about, I think what's very significant is the commitment to have reforms in the coming years, and he actually used the expression to use reforms to drive institutional reforms to drive growth, and it pledges to have some iconic reforms. So we find that's a very powerful combination: robust stimulus for countercyclical growth lift, at the same time big reforms to lift longer-term growth. So we feel quite positive about the signals this time. But obviously, going forward, we do need to see the details, the plan, the size of the fiscal stimulus, and composition and implementation.
There's a reason, Steve, that this is happening, and it sort of points to the external headwinds that China is facing as well.
Look, their domestic economy has multiple problems, obviously. The property sector has not found a floor yet. The consumer has not found its confidence yet. A number of different industries are faced with overcapacity. EVs are still trying to find their profitability, obviously. So you have all these domestic headwinds. Now, on top of that, we have the threat of a trade war coming from the incoming president, Donald Trump, in the United States, and a threat, at least at this point, of tariffs of up to 60% on Chinese exports to the United States. So they have to boost domestic consumption, do they not? Not only to take up that excess capacity, industrial capacity across the country, but of course to offset the potential drop-off of exports. So I think this statement coming from the Politburo shows the urgency that is needed, that the market has been waiting for some sort of urgency, because we had promise fatigue after all that stimulus measures that we got announced in the end of September, and then that fatigue really set in. The third plenum didn't really deliver what a lot of market participants wanted, so we turned our attention to the Politburo and now the Central Economic Work Conference. So it looks as though they've set the right tone, but again, it's following through on the tone to implementation.
Changshu, later on the shows, we have BofA Securities joining us. Let me just read you their bear case here on the currency, on the trade war. They think 8 on dollar China is bear case. You and I were talking earlier on. Markets are not as efficient in terms of pricing in the trade war.
Yeah, at this point, we do see, in terms of the exchange rates, there could be a risk of underpricing tariff risks. If we look at the historical behavior, market didn't react that strongly even before the implementation of the tariff hikes in 2018. So it could be the case that that's happening now. The markets have kind of the yuan has weakened somewhat, but not as strongly as we thought it could be. I think it could reflect a couple of factors. One factor, it could be the PBOC is kind of ready to support the yuan, and that might impose some sort of discipline on market players. But a second possible factor is, I think onshore markets players tend to be more optimistic on the tariff front. They're pointing to perhaps the incoming President Trump is somebody to do deal with, and there are some people around him who are friendly to China. So there's some sort of hope maybe tariffs won't be coming or not as bad. But our baseline scenario is that the tariffs are coming. First tranche coming in the third quarter of 25 and more to come in 2026.
So, Steve, how much room has Beijing bought itself here, and how quickly is it going to need to actually implement these policies? Because if it's waiting until, say, the MPC next year, but the tariffs are already out by then, seems like they need to move a bit faster.
Well, my sense is that they're trying to send the signaling out a little faster, and then implementation will be later, because then they can assess just how quickly the Donald Trump administration will roll out these tariffs. As Chengchi just mentioned, it could be on day one, but it might also be negotiated down, and that's the speculation. So I think they are buying themselves time without specifically giving a hard and fast number. They're basically saying that they're going to take extraordinary measures. They have the scope to, cut interest rates further. They have the scope to potentially, essentially, widening of the fiscal deficit beyond 3%. So then they can potentially again issue government bonds. They're setting the stage that they can do all these things. But I think they're waiting. I don't know if Chengchi, you agree with that or not.
I think they're waiting. I agree with you. Even we are looking at the Central Work Conference, there could be slightly more details, but certainly if the government continues the traditional plan, we won't see a target for this year. Maybe they might flesh out a bit more what those iconic reforms could be, but we wouldn't see a figure if they still keep the tradition. So they will have some gap in terms of time before they actually announce the policies and how to implement those. So there could be some lag in the policy.
Well, just very quickly, I need to pick up on that. It seems like this year is the year that they've broken with tradition. Do you think we might get something this week, actually?
It's entirely possible. I think this time we see it's quite encouraging. The government is providing forward guidance, is trying to communicate better with the market. I do see this is an improvement, but at the end of the day, as we discussed, we do need to see specifics of fiscal plan, reform plans, and follow through of those plans.
I'll just add one last thing. I think they learned their lessons from 2015 when there was a currency shock and they didn't communicate to the market, and the market panicked. And they've also seen in September when the stimulus came out, they didn't really have very good follow-through messaging after that. So I think they're getting better at that.
Yeah. So. August 11, 2015, that's still tattooed on my mind, actually. That day. Steve, Chengchi, thank you so much, team. Breaking down first the initial take there on what was announced post the close yesterday on short. Counting down to the open of trade in Shanghai and Shenzhen in Hong Kong, this is the China Show. Good morning. Welcome back. You're watching the China Show. 13 minutes to the opening bell. We're looking at mainland markets more specifically today, given that that market was shut, and then the markets then news broke, of course, out of Beijing. How much near-term upside has all the news opened up for Chinese markets over the shorter term? Let's bring in Tai Hui, JPMorgan Asset Management APAC Chief Market Strategist. Why don't we start with that question? Near-term impact.
I think the market is moving towards the end of the year with more optimism.
Okay.
Not only the Politburo comments yesterday, I think that helped, but also I think the overall tone of the government's policy over the next 3 to 6 months continues to be ongoing support for the economy. Now, we've had that since late September, and frankly, we're still waiting for a lot more of the details. But I think the fact is, when you're looking at the global environment, it's getting more uncertain, getting a bit more volatile. The fact that the Chinese equity market is still quite attractively valued, I think that does help to attract some investors to come back in.
But again, do you see it as sort of a near-term story, or are you actually thinking if you've got a longer-term horizon that there's enough to bring you back in?
I think
right
most
now?
people would still see this as almost a tactical opportunity. So more shorter term, really waiting for the stimulus to come around, and also the rotation potential within the markets. Because if you look at the last year and a half, almost 2 years, there's high dividend stocks, banks, telecommunications, the safe and dull stuff, the state-owned companies. And then since end of September, you've actually had the IT, the semiconductor sector that really outperformed. So I think if we get more support for the economy, if you get a bit more consumer spending going, you may see more of the rotation into the internet stocks, into the consumer stocks, which frankly have underperformed for the past few years.
There's always a risk anyway, but a policy vacuum, if you look at the calendar, right? So we had the Central Economic Work Conference, and then probably the next big event will be the 2 meetings. And I'm wondering, do we find ourselves likely in a very tight range between this week and then? What would be the next catalyst that could unlock this between those two major events?
I think, obviously, from China's perspective, the policy outlook will be driven by the Central Economic Work Committee and also the National People's Congress in March. But don't forget the external factors. President-elect Trump will be inaugurated on Jan 20th. How does what's his first couple of weeks look like when it comes to trade? I think that will also influence the Chinese market. Don't forget, if you look at whether it's CSI 300 or MSCI China, domestic demand still makes up a significant share of that revenue stream. So you can argue that trade is more of an indirect impact on consumer sentiment, on business sentiment in China, but I think that still matters. So if you get a slightly more friendly tone from President-elect Trump like we did earlier this week, then maybe the market will find a sign of relief. But at the same time, I think you've seen in the last few weeks also that the underlying the battle on export restrictions, on export bans, those will continue to play a role in the Chinese economy.
Right. And do you suspect, back to your earlier point, state-owned plays, income dividends, do you think that remains a popular trade? And, we're looking at this massive rally in the bond market. Does this actually make CGBs a lot more attractive than the equity complex, counterintuitively?
I think the challenge with CGB is that the yield's so low now.
Right.
For an average investor.
But they've done so well, though.
They've done very well.
Yeah.
But then the question becomes how much further can it go?
Right.
Because ultimately there is still I think from an earlier segment I've heard you talk about the renminbi exchange rates. The rate differential between the US and China, that still matters.
Okay.
So I do think that the PBOC would allow bond yields to fall a bit further with more monetary easing, but that scope is becoming narrower. So again, from a Chinese investor perspective, I'm not getting I'm getting less than 2% on government bond yields. I could get a little bit more from high dividend stocks. And meanwhile, there could be a better prospects on the broader economy. So I suspect there could be more of a rotation towards equities, even from a Chinese domestic investor perspective.
Well, actually, we're just showing there what the Hang Seng's doing in pre-market, and it's up more than 3%.
Wow. Okay.
I'm interested because we've had this before. We've had sort of stimulus announcements. We've seen the euphoria. Yeah. It's given up. And how long do you think this lasts this time around? And how much more do you think policymakers need to spell out the details before people actually listen for longer, I guess?
I think if you look back to the experience of late September, I think the market have weeks of patience until you get more details coming through. And frankly, I'm not expecting a lot of quantitative details from the Economic Work Committee this week. But between now and the end of the year, and perhaps rolling into Lunar New Year, you may see more policy announcements in terms of what to do with the support of the property sector, how they beef up local government spending. So I think that, again, to me, is going to be the important gauges, whether this rally can be sustained. Because if you look back to the local government debt swap announced a few weeks ago or in early November, that, to me, was to at least fix a leaking bucket. Because if local government spending is still leaked away, or additional resource being leaked away from this hidden debt, frankly, additional resources is not going to be particularly helpful to boost the economy. At least they patch up some of the leaks, and that allows for additional resources to flow into the right places. For example, maybe consumer spending, maybe allowing local governments to purchase more of the inventory from the property market.
Yeah, we know consumption and the property are really two key sectors for China. Well, Tai Wei from JPMorgan Asset Management is staying with us. We're going to have a lot more ahead as we count down to the open of trading in mainland China and Hong Kong. And certainly you've got that indication that a lot of traders' attention has been really piqued by these stimulus announcements overnight. So that is what we're seeing in pre-market. More ahead. This is Bloomberg. Well, what a day to be preparing for your IPO in Hong Kong, because we've had session after session of equities in the red. And this morning, perfect timing really for Mao Geping to be listing. This is a cosmetics giant from China. This is a renowned Chinese makeup artist. Actually, he's taking his beauty company public and raising up to 2.1 billion Hong Kong dollars. This is the first consumer cosmetics company from China that we've seen listing in the city. But it is, as I said, really great timing when you've got China vowing to boost consumption and also to try and boost that domestic economy as well. So that's what we're seeing in pre-market there. We'll have the open in just a moment, but also tracking some of the other consumer heavyweights in the city today as well. Meituan, for instance, is one of those. Tencent as well. You are seeing some significant gains here across the board, and it comes down to what we had from the Politburo overnight.
Yeah, and, to Belle's point, right, there's probably no better perfect day to really go public on a day like today, right? 3.2% on the Hang Seng. This is already on top of the 3% gains I think we had yesterday as well. So this actually puts us within striking distance, maybe a good 2 weeks away from, retesting year-to-date highs. Anyway, we'll talk about those levels. The opening is next. This is Bloomberg.
All right, we've been talking about what perfect timing it is for Mao Geping. This is the Chinese beauty firm to be listing this morning in Hong Kong. Of course, we're getting that real day one reaction to the Politburo announcing new measures to have looser monetary policy, but also to try and boost domestic consumption. So you're just looking ahead of that stock starting to trade in Hong Kong this morning. Already we'd seen it rising 60% in pre-market, and it has done very well compared to international labels. This is a beauty company that's really putting its products on a par with the likes of Shiseido, for instance, in Japan, NARS, other very well-known beauty brands.
The cameraman don't need some lessons in just taking a wide shot and not following the baton around. We know where it's going to be, and we know where it's going to be right now. Zoom in. Let that sink in. There we go. Up 60% in the early goings. What a perfect day to go public, really, with the market that's doing this. 3.3% on the CSI 300. 4100's now in play on that specific market. I haven't looked underneath the hood, but I would imagine every single stock, if not most, in terms of market breadth is on the way up. It's worth noting, of course, that we've been saying this earlier on, that this market was shut and then news broke out of the Politburo. Okay, cameraman needs lessons again. Let's change things up, please, and have a look at Hong Kong and where we are as far as that's concerned. I mean, we don't really need to because, oh no, 21,000 right now on the Hang Seng Index, and we are just a little bit below that level. HS Tech, 3.4%, and some of the heavyweights, bottom of your screens, Tencent, Alibaba, Meituan, all up significantly. We were up 8% in the Golden Dragon Index up overnight. Some sectors in focus as well. So you had property for fairly obvious reasons. They singled that out. The stock market, developers are up 6.4%. The gaming stocks and casinos are up 3.4%. Discretionary shares are up about 3.5%. So suffice to say, it's a good way. It's a good time to be long these markets right now. Right. How far are we from the highs before gains of today? So I think we're still about 8 to 10% away from highs in Hong Kong. We actually should be there already on a closing basis with the gains we're seeing in the early going. So don't be surprised if we certainly retest the headlines and some of these levels from late September, early October in today's session. We'll see how today simmers as well. Tai Hui is still with us, APAC Chief Market Strategist at JPMorgan Asset Management. Is the risk to these Chinese markets domestic or is it external?
I would think it's largely domestic. I know there's a lot of noise coming from the U.S. on tariffs, on trade policies, on geopolitics, but at the end of the day, you guys mentioned earlier, it's about the property market and consumer spending. And frankly, these areas have been relatively weak for the past 3 years since the COVID pandemic. So I think from that end, again, how consistent and how forceful these stimulus are going to be to support the economy to really resuscitate consumption. That, to me, is the absolute key. So it needs to be both addressing the property market issues, but alongside with the labor market issues, which, again, as we've seen in the past couple of years, job growth has been slow, income growth has been slow. We have seen Chinese consumers save up more, so there is a potential pent-up demand, but they need to feel more confident before they can spend. So, we mentioned this a couple of times before, where the central bank can cut rates, can cut triple Rs, but if businesses and consumers don't feel that level of confidence, that lending growth is not going to re-accelerate.
Yeah, we've seen really weak corporate and household credit demand. Then if you're not really seeing this as sort of a long-term story because the problems in China's economy are long-term problems and they require long-term solutions, where are you looking then outside? I
think for this go from a tactical to a more strategic long-term investment recommendation, we have to take one step at a time. And it's, again, coming back to whether the government can actually engineer a more sustained recovery in the Chinese economy. Because we've had these rebounds before, and quite often we don't get the economic data to match the expectation, and that's where the momentum fizzled out. So, again, I think the hope right now, whether it's coming from the end of September or what happened or the announcement yesterday, is whether we will see more consistent, more aggressive policies to support the economy. And again, if the data coming in after the Lunar New Year in March start to show that the economy is starting to bottom out, you could argue that more investors will see this as a longer-term opportunity rather than just a short-term trade ideas from a Chinese equity perspective.
Could it re-accelerate inflation around the world?
I don't think so at this point in time, because ultimately the spare capacity in China continues to be quite significant. And yes, Chinese consumers may spend more, but I don't think this is going to be the V-shaped rebound that we saw, for example, at the end of the pandemic. So I think from an inflation perspective, frankly, China needs a bit more inflation at this point, but I don't see that turning into a problem that could challenge the central bank's policy stance anytime soon.
Okay.
What about inflation then in the US from Trump's policies? Are you seeing that as a risk?
That is a risk because a number of policies he's been advocating, whether it's in trade, in immigration, in fiscal spending, all of that has an inflation bias. But again, the question is, how are these policies going to be executed, for example, on tariffs? Obviously, if you lump everything in one go, the economy, both in the U.S. and the broader supply chain, they won't be able to digest a 60% tariff on all Chinese exports. But if these were implemented in phases, I do think that the economy and the supply chain will be able to absorb some of that before that being passed on to U.S. consumers. And don't forget, the fact that the U.S. CPI index, a significant share is in housing, in services, these will be more resilient against the tariff and plans. But of course, when it comes to things like immigration, could we see some deportation of undocumented workers? That could potentially heat up the job market again. So I think a lot of that is what you would expect to see in actual implementation, and so far we think is still going to be manageable. But it does make the Fed arguably going to be a little bit more hesitant on cutting rates in 2025.
Which might be a good thing, because I think markets have run with the idea that the economy is doing well, even if the Fed doesn't need to cut interest rates. Why even bother looking anywhere else if U.S. equities keep doing what they've been doing?
No, I do think that the U.S. is a very attractive market still at this point in time.
Okay.
Especially as you rightly mentioned, we're expecting a soft landing in the U.S. economy and the Fed cuts. This combination historically has been really great for equities, including the U.S. I think the area where we get some pushback will be on the valuations on especially the technology sector. They've done really well in the past couple of years. We think that the growth cycle is likely to be extended, and that to me could argue for a broader range of strong performance from cyclical sectors like consumers, like industrials, even in financials.
If tech is doing well, though, do you want to look into areas like Taiwan, for instance, or even Japan, where tech is cheaper?
Yes. So for Asia in 2025, I think the core allocation will still be more towards technology. Taiwan is a great example. We think the AI boom, you can argue that's been very much driven by data centers because a lot of the AI developers are buying those spaces. But you can argue also that a lot of non-tech sectors, financials, healthcare, consumer services, they're also investing in AI. So the ongoing demand for semiconductors supporting those calculations and large language model, they'll continue to thrive. Japan also is a great example, and also on top of that, the ongoing corporate governance improvements in Japan, that's also a very important theme. The other question would be on supply chains. Could we see more diversification into Southeast Asia, into India? I think those could also be long-term investment themes, as we look for ongoing supply chain shifts around the world.
Korea seems to be missing from everything you just mentioned there, because you could replace everything else with Korea. Value-up program, technology. I know they're not the same thing as Taiwan, but do you buy this Korea dip?
I think the challenge with Korea is a couple of things. The value-up program is just started. And therefore, if you look at Japan, the whole governance improvement, really, the program started back in 2012. So it's going to be a multi-year progress to get to a point where investors appreciate what companies are doing. And also, if you look at Korean companies, their return on equities tends to be relatively low compared to the rest of Asia. So we really need more evidence that's moving in the right direction before investors will look into Korea with more conviction. And of course, the more recent political uncertainties in Korea could also be forcing investors to be more hesitant on the Korean market.
All right, Tai Hui, thanks so much for your time this morning. That was Tai Hui, their APAC Chief Market Strategist at JPMorgan Asset Management. Of course, sticking with that theme, that idea that Korea is behind in the AI race, and staying with tech as well, because China's opening an investigation into Nvidia over suspicions the US chipmaker broke anti-monopoly laws around a 2020 deal. The move's seen as a response to escalating US tech curbs. Let's get more on this now with our Asia government and economy correspondent Rebecca Jung-Wilkins joining us this morning. So, Rebecca, I mean, it seems like there's at least a strong geopolitical overhang over this, but talk us through what's been announced.
Yeah, I think geopolitics certainly is the flaw here, and it's sort of that idea of the noise that Tai Hui is talking about that everyone is dealing with. I mean, in some ways, this is a precursor to a potential trade war with the US. We see Beijing sort of sharpening its spears, sharpening its sword here, using one of the tools that it has at its disposal to try and push back against some of the US measures. So this sort of probe into Nvidia, it has echoes of earlier probes that we saw into Micron, for example. But, of course, it is a painful reminder for Nvidia, precisely what it has at stake. 15% of its customers are in China. It's going to be extremely expensive if its business is sort of severely, significantly limited as a result of this. Details on the deal itself. I mean, China is using sort of anti-monopoly investigation into a deal that Nvidia did back back in 2020. So we are reaching back into the past here. And it's an important reminder, I think, or an important hint about just how China might continue to respond to some of these pressures from the US as, the prospective administration, we assume, will continue pushing on a lot of these fronts.
Is that story permeating into other things like this drone story, of course, where we understand based on sourcing that China's limiting some of the supply of drones, critical, of course, to what Ukraine is trying to do?
Yeah, I think this is really an interesting idea where what we're seeing is a squeezing of the supply chains on all sides, right? So we have the US squeezing China's supply chains, its access to chips and so on. But China, for its own part, also exercising, as we hear from sources, its own ability to squeeze the supply chain. But I think it also underscores a really critical issue. Something I hear from sources a lot is this renewed urgency from the Europeans about China's still allowing Russia's access to key strategic technologies. And this kind of story here that we're hearing, that in fact also China potentially is going to squeeze Ukraine's access, is really going to be a concern. This has become a much more pressing issue. Again, speaking to this issue of the US and Donald Trump returning, this is becoming a much more pressing issue because Donald Trump has said that he wants to pull back on US support for the war. Pressure is mounting on the Europeans to find a solution here, and one that increasingly looks like it will have to include China in one way or another.
Rebecca, thank you so much. Rebecca Chung-Wilkins there, our Asia government and economy correspondent. Back to markets right now, 11 minutes into the session here. All but one of the major sectors in the CSI 300 are up, led by consumer staples, consumer-facing really, so staples and discretionary. Your big four on your screens. Next page shows you discretionary. Some of your cyclicals, like materials, for example, also seeing some upside right now. Overall, we're up about 2.5% on the CSI 300, 1 month high on the benchmark there. And just to take you through the rest of this list, all things, including things like energy and telcos, also seeing a little bit of upside too. All right, that's a market story for now. Plenty more ahead. This is Bloomberg.
Well, we are seeing some significant gains here for Mao Geping. This is a cosmetics brand from China. It's just listed in Hong Kong this morning. Those shares started trading 15 minutes ago, and significant upside that we're seeing so far. Of course, we're talking about really perfect timing because you've got the Politburo announcing this shift to looser monetary policy, but also that focus on consumption, and they want to try and boost domestic demand. So this is a company that really plays very nicely into it. Mao Geping, this is a very famous makeup artist in the country, and he launched his own beauty brand back in 2000. It is one that has a price point that's actually similar to a lot of well-known Western names as well.
Okay, well, are you talking about the product or the IPO itself? Because it looks like the bankers might be scratching their heads. They kind of left some money on the table looking at how much it's done in the early goings as well. But who would have known that the news gods would rain on this in a very good way, of course, looking at what's happened today. And I think the other question, too, Bell, to your point is, might this be a catalyst for other companies that are looking to list, that are ready to pull the trigger? Might this be something that allows them to bring forward some of those plans, looking at a first day such as this? Let's bring in our Bloomberg Intelligence team here, of course, to talk us through this. I mean, certainly when you look at what they're saying, they're putting this out, the outlook for Hong Kong listings is bright. With the current pipeline, to our point earlier on, is as full as it's been in years. Shirley Wong, our senior research analyst, is here to talk us through their new reports. And yeah, juxtapose this outlook for IPOs in Hong Kong and maybe separately in mainland China.
Yeah, so for Hong Kong, definitely it's a very bright outlook, and we're anticipating that the momentum in the fourth quarter should carry forward into 2025. So for next year, our estimate for IPO capital raised is about 20 billion. So that's a lot more than this year, where it's around 11 billion at this stage. So, there's a huge pipeline of listings. The regulators are very forthcoming with the approvals for overseas listings. We've got the mainland companies coming, potential dual listings. We've got potentially US listed companies that are still looking, to list in Hong Kong, given the change in the political landscape. So just, very bright outlook for Hong Kong. But then when we look at mainland China, it's the opposite story, because the regulators are still slamming on the brakes. It's been over 14 months now. So there is a chance that they could ease the crackdown on new listings, but we're not really betting on that. So the excitement is definitely still in Hong Kong.
And with that excitement in Hong Kong, which names are most likely to benefit here? As in, like, which parts are we talking about? China brokers? Like, what's their part in it
right.
as well?
Yeah. So for the Chinese brokers, definitely. The ones with the largest overseas business should benefit. So, for example, CITIC Securities, they own CLSA, also CICC. So a lot of the investment banks do benefit from overseas. But then, having said that, they have a huge onshore business. So so a broker like CICC, because of a huge onshore business, they're actually suffering net. So, key things to watch for the brokers, it's more on the stock market liquidity and the sentiment, because that's where the policymakers are really, pushing for the stock market liquidity to improve. And the brokers with a bigger brokerage business versus investment banking, those ones should benefit, like China Galaxy.
And how does this filter into things like comp, for example? Bonuses, staff pay, is Feb and March going to be a very good 8 weeks here for bonuses?
So sorry to break the news, but it's very unlikely because the regulators are still scrutinizing executive pay. Yeah. So profit, as we all know, fourth quarter, should be really strong. 2025 should also be up year on year. But when we look to year-end bonuses, it's unlikely to rise. So far this year, when we look at the first half comps, it's down about 15% for the industry overall year on year. And it's unlikely going to go up. But having said that, it benefits the brokers. We anticipate their cost-income ratio to rise as the comp ratio falls. Yeah.
Not much fun then for some people who might be listening.
Sorry.
All right, that was our Bloomberg Intelligence Senior Research Analyst, Shani Wong there, and we'll have plenty more ahead. This is Bloomberg. Some of the global stories that we're tracking this morning, and US President-elect Donald Trump says he's had communication with Chinese leader Xi Jinping in recent days. It's the first clear indication of direct contact between the two since Trump's re-election in November. He told NBC about the exchange in an interview that was taped last week without specifying what was discussed. India has named career bureaucrat Sanjay Malhotra as the new governor of its central bank. It ends weeks of speculation over who would lead monetary policy in the world's fastest-growing major economy. The Princeton graduate begins a 3-year term on Wednesday, succeeding Shaktikanta Das, who's been the RBI chief since 2018. Police in Pennsylvania have charged a man with gun crimes after his arrest as a person of interest in the killing of United Health Group CEO Brian Thompson. 26-year-old Luigi Mangione was arrested after a tip-off at a McDonald's restaurant in the city of Altoona. New York police will interview Mangione over last week's killing. They allege he was found with a so-called ghost gun that may have been 3D printed. South Korea's Chosun Ilbo newspaper says the ruling People Power Party will disclose a roadmap on Tuesday for the orderly exit of President Yoon Suk-yeol. Yoon's been banned from travelling overseas as a series of investigations put him at risk of detention over his chaotic declaration of martial law. The main opposition party says the parliament intends to pass a new budget today to help clear the uncertainty.
Okay, let's have a look at these markets right now and start things off there in Seoul. I think we're up for the first time in 6 days. And certainly the declines we had yesterday did push some of the metrics here maybe into oversold territory. It's worth noting as well, this is one of the cheapest markets in the world on a PE basis. It's one of the worst performers this year. The Kospi index is up 2.3%, which basically takes you back to levels yesterday. Kosdaq index, where really the gravity of losses were concentrated yesterday, up about 5%. So you are getting somewhat of a technical bounce going into the session today. The property story, and just to shift gears to the Chinese markets, and that's actually doing quite well. And we're up about 1 to 6%, depending on where you look. Some of the more specific pronouncements will be, was a vow to stabilize both the stock and the housing market separately. And yeah, Belle, you guys were covering the story, No, like the pronouncements going into the breaking news going into the Central Economic Conference this week, of course.
Yeah, exactly. It's sort of been that countdown to what was going to be revealed in the meeting, and also the tone that was being set by Xinhua, because we had those sort of proclamations, different articles starting back from last week, but indicating that they were serious about addressing things like the issues in the property sector. In the market reaction today, I think it's also really notable the moves we're seeing in the bond space, and you've been discussing this, Dave, but we're below that 1.9% mark now, and some people we've been speaking to said it could reach down to 1.8, for instance. Given you've got those expectations that are continuing to build of further easing, but it's also how much patience is there for investors? This sort of euphoria we see in markets, how long does it actually last for? But it does seem like they've given themselves a bit of breathing room, perhaps into the new year.
Yeah. How long does maybe to borrow a Peter Pan analogy, the pixie dust last on these markets, or do we revert back to sort of a Lost Boys narrative here? On these markets. I mean, to the point we were having this discussion before the show started, right? And as you look at the next level to watch on the CSI 300, what's really the difference between this change in monetary policy if they've been cutting all year and if rates are now lower than they were actually during the GFC? I think our guys at Bloomberg Economics are working that one out. Tai Hui, who joined us on shows this hour, also had a similar view that they've effectively stated what's taken place. Does it open up a lot more ahead? And hopefully it does for these markets. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show, where we're charting the market reaction to what's been China's top leaders pledging their strongest support in years to try and prop up the economy. The reaction that's coming through today is really most notable when you take a look at what's happening in the mainland equity space, because trading volumes are a lot higher, again, in China than what we're seeing in Hong Kong today so far.
Yeah, absolutely. And I think that to your point, right, if you look at both markets separately and relatively speaking, Chinese markets, mainland markets have done better than Hong Kong in terms of being closer or not retreating as much from their highs. In fact, going into the session today, the Shanghai Composite, the Shenzhen Composite were about 2 to 5% from the highest close of the year. Hong Kong is still about 10% from that point. The other point, too, is I think we were noting this yesterday was the news came after the mainland market shut today. So there's an element of catch-up, I guess, today taking place onshore. And I think that's really what we're seeing as far as the dispersion in returns today, 1.8 on the CSI, 0.8 on the Hang Seng Index. It's the 10-year yield, though, that's really giving us a lot to talk about today. We're below 1.9%, and we don't normally see a 6 basis point drop on the Chinese 10-year yield, which actually matches the biggest drop on a net basis so far in 2024. To Belt's point, turnover and volumes are picking up. So we're now about half an hour into the Chinese market session, and already 800 billion has been traded onshore. So a little bit more, and we'll cross that 1 trillion mark. I think the chart that's coming up on your screens very shortly will show you that. The post-pivot average is 1.9, give or take. So given the current telemetry, just to borrow a space phrase here, will probably be at that level, if not above it, at the end of the session. The question is really how long this lasts, this initial euphoria. Oh, initial, I already said it. Let's bring in Mark Cranfield, our MLI strategist, joins us right now, and also Shuli Ren, our Bloomberg opinion columnist, to talk us through the market moves today. Mark, let's start with you. Where's your head on this rally?
Yeah, I mean, I think the timing is great from China's point of view. They've got a nice little runway here because Trump doesn't get inaugurated until later in January. And if they can get enough momentum going in their markets, both in Hong Kong and China, in the next few weeks, that will really set them up. Obviously, they'll be anticipating there's going to be some pushback when we get the revelation of what really is going to hit them in terms of new trade tariffs and anything else that the new president will have up his sleeve. But markets are very much, there'll be a lot of talk about the economic data, about what policy is going to be in terms of lowering interest rates and all those things. But really what drives equity markets is P&L. And if traders are building up enough resilience in terms of making money between now and the time that Donald Trump comes into office, they will be much more comfortable about withstanding whatever kind of hits come their way. So this really, next few weeks is really important. If there's strong momentum going into the middle of 2025 in January, then Chinese equities can probably hold it for some time. If they don't, if they falter before then, it's going to be a very different story.
Shuli, how are you reading the announcements? Because, I mean, your column tells us you're a little bit wary of what we've heard so far.
Yeah, it has been all thunder, no rain. China has been talking about big stimulus package since late September, and it's been 3 months, and we have not seen any concrete actions, right? And I think anyone who is still thinking about investing in China now, they need to ask why the discrepancy. Why are there so many words and no actions at all?
Shirley, let me ask you this, though. Do you think if Donald Trump wasn't coming into office and the policy response was predicated on the threat of tariffs, do you think we would have gotten more from Chinese officials at this point?
I think so. I mean, let's look at the Chinese economy in 2024. Exports was the only stronghold, right? And then with Donald Trump's and even more tariffs on the Chinese imports, it's going to necessarily hurt the Chinese economy. And I do think that the stimulus package will be a little bit bigger because of the Trump presidency.
Mark, beyond sort of one of the reasons we've got this stimulus measure being announced, not really beyond it, but it is sort of the US-China relationship. And just today or overnight, we've also had China saying that it's opening an investigation into Nvidia. So do we see this sort of having any flow-on effect to the US as well?
Yeah, of course. I mean, you can already see Nvidia shares have come off. People are obviously a bit nervous about that, although it's a huge company with a very diverse base of businesses, so that will probably get shocked off before too long. The AI story looks as though it's got a lot of legs to go so far, so people are not going to give up straight away. But certainly it's an interesting tactic from China to address it in that way, and then maybe they've got more up their sleeve in that respect. And they're probably working on the basis that Donald Trump is a businessman who negotiates on a deal-by-deal basis. So if he throws something back against him, then certainly there's room for discussion, all that sort of thing. It's a clever tactic from China's point of view, and investors may well see that as being a smart move and give them a bit more confidence in what's happening in Chinese markets. It really, as we've been saying for some time, the tactics for trading markets, so now that we've got a new president coming in the United States, are going to be vastly different. Short-term traders, headline traders are going to be very well suited to what comes ahead. It's going to be much more difficult for traditional portfolio managers to stick with it through these kind of conditions. But if there is room for everybody to do well here, Chinese markets still look relatively undervalued compared to the US markets. Of course, most markets look undervalued compared to the US. So if the PBOC does their part as well, one of the most interesting things in September is markets did best when the PBOC was speaking, when the PBOC was lowering rates and talking about the support measures for the markets as well. So it really needs the PBOC to do a bit more as well and get out in front, which the wording that we've seen so far from the Politburo suggests that they fully support more monetary easing. So PBOC is not far away, and that will be reassuring to investors in China.
Shuli, if we look at the Chinese equity market purely from just a tactical perspective, forget the long term, which, the debate is still, the jury's still out whether or not they've done enough to attract the long-only investors back in. Does the market look attractive? To Mark's point, it's cheap. The next 20% move will be what, up or down, you think?
I think it's one thing to be cheap. It's another thing to be a value trap, right? The problem with China is that it has become such an opaque system that foreign investors are just always 1 or 2 steps behind. And then the Chinese markets just rally so fast because there's a lot of insider trading, to be honest. And by the time you have done your analysis, figure out the concrete details, it's already too late. And then you become the one holding the bag. So I think this is perhaps why, offshore, in Hong Kong market, there's less enthusiasm than onshore, because onshore there's a lot more retail momentum going, and there was talk about China setting up a stabilization stock fund, right? Whereas offshore we don't have that kind of guarantee.
So how long then do you think, going back to what we were discussing earlier, but how long do you think, or how much breathing room have policymakers bought themselves here, do you think?
I think for the central government, there is indeed a lot of breathing room, right? Like the central government itself doesn't have that much debt. It's the local governments that have a lot of debt and that have hit their debt limit. But the question is whether the central government is willing to come in and take on all the financial burden. And you can see that President Xi Jinping is a little bit hesitant about that.
All right, that was our Bloomberg opinion columnist Shuli Ren there, and also our MLive strategist Mark Cranfield. Thanks very much to both of you. Still ahead, we are going to be sticking with the China story and taking a look at how it's playing out in FX and bond markets. Also taking a look at Bank of America Securities, their outlook into 2025, how they're playing the prospect of Trump tariffs and a possible trade war that really does seem to be already underway. But we'll have more ahead. This is Bloomberg.
So the rally continues, day 2 in Hong Kong, day 1 in China, on the back of the new pronouncements. Not precisely new stimulus. We are getting firmer language, though, although certainly the devil is still in the detail here. That's from the Politburo. That's ahead, and just to clarify, ahead of the Central Economic Work Conference that takes place tomorrow, and ahead of the 2 meetings, of course, in March. Those 3 things are connected. 1.5% on the Hang Seng Index. CSI 300 is up about 2.2%, which should be near the higher point of the session. Dollar China is now at 725. Coming up on your screens very shortly is Dollar Korea and Dollar Yen. Bloomberg Dollar Index or the Dollar Index itself, 106 right now, 12 on the Dixie. Joining us here on set is Adarsh Sinha, co-head of Asia FX and Rate Strategy at BofA Securities. Good morning and nice to see you.
Good morning. Good to be here. Thank you.
Yeah, I mean, dollar index at 106. How much more upside do you think we have near term on the benchmark?
I'd say, over the next 2 to 3 months, we're forecasting about maybe 2% upside for the DXY, implied upside. The way I think about it, we all think about the Trump policy agenda and what it means for the US dollar. I think if it has to be priced in, it's going to be priced in sooner rather than later, heading into inauguration, maybe a bit after that, because by that time, we'll have an idea what the sequencing of policy looks like, what the magnitude of some of the policies like tariff increases and tax cuts looks like. So markets are forward-looking. So I think we have a bit more dollar strength from here. That'll happen in the first quarter, and then we probably stabilize a bit there, depending on which currency you look at, of course.
And just thinking about the dollar as well, which one has the bigger bearing, I guess, the Fed cuts or the tariff story?
I think the tariff story in the near term, Fed cuts, it's kind of priced in. We're pricing in a terminal rate around 3.75 to 4%, which is our forecast as well. I think that's largely done, at least for the time being. So in the near term, it's more about the tariff uncertainty because we know tariffs are going up, but we don't know precisely how much. And that risk premium has been priced in to some degree, but probably not sufficiently yet.
Yeah. Talk to us about that, the risk that we haven't fully priced. Not really worst-case scenarios, because we don't really know what information is there. But do you get a sense, looking at exchange rates right now, that markets are underpricing likely base-case scenarios?
Yeah. So I think the risk premium is on the lower side. I still hear a lot of this escalate to de-escalate, that there'll be the threat of tariffs, but it might not ultimately go up by that much. And then I look at specific currencies. I look at the CNH, obviously. It has weakened, but it hasn't weakened as much as you'd expect if tariffs were to go up by 10 to 20 percentage points against China. I look at something like the Australian dollar in this region. It has weakened somewhat, but in 2018-19, it was the worst performing currency as tariffs went up against China. And I look at volatility markets. Volatility has gone up a little bit, but not that much. So the market is pricing it in, but the risk premium is still on the lower side, in my view.
So if they were to go up 10 to 20% tariffs, what does your model tell you on where dollar China is, base case, and what's the worst case?
Sure. So our base case for tariffs is the effective tariff rate goes up from 20% to 40% eventually. And that would imply, in our view, the dollar CNH should be at 7.6. And I would argue sooner rather than later because the market is forward-looking. And then we have a bear case where if tariffs did go up to 60%, which is ultimately what the Trump administration had proposed, we don't know if that will happen. But if that does happen, you don't have to get a one-for-one offset, but it probably means dollar CNY closer to 8 in our bear case scenario.
Which other currencies then are most vulnerable in that sort of environment? You mentioned the Aussie, Korean won, the major trading partners, I guess. Yeah,
you mentioned the two we've recommended being short in our year ahead. So we're short the Aussie as a first quarter trade. We short the Korean won as well because Korean won is partly CNY depreciation, but it's also the DRAM cycle. Prices are falling. There are risks to the export cycle for the Korean won. You're also seeing portfolio outflows. So a lot of things aligning for more Korean won depreciation. But more generally, Asian currencies will be vulnerable against that backdrop. Almost all of them have a high sensitivity to the CNY.
That takes us into the BOK story. They're having to juggle a lot of things right now. And not that they're hawkish to begin with. I mean, they've opened the door for a third cut.
Yeah.
Where do you think we get on BOK next year? And do you think the markets are priced it properly at this point?
Yeah. So, we get more rate cuts. We have recommended receiving interest rates, so positioning for lower interest rates in Korea at the 3-year point of the curve. I think the inflation dynamics are quite different compared to, say, the U.S. So quite often you think, will BOK cut by the same amount as the Fed? There's a possibility that they could cut by more and at a faster pace than the Fed as well. Yes, it is negative for the currency, but ultimately if the dollar is strengthening against everything, we do think they'll accommodate a weaker currency and sort of choose to use the interest rate lever a bit more in 2025.
What about, speaking about central bank action, BOJ, of course, and we've got the meeting coming up next week, but you're seeing it at $160 yen by the end of next year.
Yeah. So, look, I think we spent a lot of time discussing the BOJ December versus Jan. I think in the bigger scheme, stuff like that doesn't matter as much for dollar yen, doesn't matter as much for the yen. The biggest story for the yen is Japan as a country for a long time has been overweight cash, which is corporates have been overweight cash, households have held over 50% of their balance sheet in cash. And what we are seeing over the past year, a couple of years in fact, is diversification into financial assets, including foreign assets. This is why the yen has been weak. It doesn't have to do with Bank of Japan interest rates. It doesn't really have to do with risk off, risk on. It just has to do with the diversification of the Japanese balance sheet. Now, this did slow a little bit in the second half of 2024 when we look at the data, but we expect that to resume now that the U.S. political uncertainty is behind us. And that's why we're calling for 160 on dollar yen, which I think is a bit counter consensus.
What do flows look like in that scenario in terms of the outflow story there? Like, do we have rough numbers to go by there?
If you think about outward FDI, we've been seeing record outflow for quite a few years now, except 2024. It was on the slower side. So I think if we get back to record outflows, again, we talk about billions of dollars of outflows by Japanese companies. And households, it's a bit harder to measure precisely what outflow you're seeing, but you can look at the investment into foreign asset investment trusts, what are called Toshin funds. And again, 2024 has been a record year of outflows by households. So if that continues, and we look at it in the context of the broader balance of payments, Japan is running a balance of payments deficit in our view, which is why the yen is weak.
Looking into next year, and we're asking a lot of our guests this week about sort of their outlook or year-ahead questions, but what are you seeing as the biggest risk on the horizon right now?
Yeah, so we discussed tariffs already, so I think that's clearly top of mind for a lot of people. I think in the case of the U.S., maybe there's a bit some concern around U.S. economic resilience and what if that means higher U.S. rates for longer, which is always a problem for us in this region and for inflows into this region. I'm a bit less concerned about that because I think ultimately a lot of the tailwinds like excess savings and catch-up hiring in the services sector in the U.S. will fade in 2024. So I do think we see some deceleration in U.S. growth and the Fed can continue cutting rates. And yeah, I guess geopolitical risks are always top of mind.
Yeah, how low do rates get in China? Just to pivot back. So we've talked about the exchange rate. You look at the 10-year now at 1.8%, maybe on the short end. Like, how do you play the CGB market?
Yeah, we're long 5-year China government bonds, but yields are very low. I see where you're coming from. Yeah. Yields have fallen a lot. We expect another 30 basis points of rate cuts, policy rate cuts from the PBOC. I know there's a lot of excitement around the Politburo statement around looser monetary policy, but there's not that much further that they can cut rates at this point. Bond yields will move down in our view, but the big move is probably behind us for the time being.
And why the 5-year in particular is my question.
So the 5-year is sensitive to policy rate cuts.
Okay.
Whereas it's perhaps less sensitive to more issuance, and we will see more issuance because the fiscal deficit is likely to go up next year. So if you go beyond 5 years, there might be some pressure from supply, which is why it's kind of the sweet spot in our view.
Target for the 10-year as well, because we've just been seeing it this morning moving down.
Yeah, we're expecting maybe another 10 to 20 basis point move lower from where we are right now. I'd say that's our forecast.
Right, that was Adarsh Sinha there, co-head of Asia FX and Rate Strategy at Bank of America Securities. And a reminder, of course, that the US Treasury Secretary Janet Yellen is actually joining Bloomberg Television on Wednesday. That's for an exclusive interview ahead of her departure. So 11:30 p.m. if you're watching in Hong Kong, that's 10:30 a.m. in New York. We'll have a lot more ahead. This is Bloomberg.
Okay, just some breaking news right now, at least more on this developing story in South Korea. So you have Money Today reporting that the PPP is discussing an exit of the president, and the timeline is on your screen, so it's still a couple of months away, 2 to 3 months, February, March. Right side of your screens is the market, not so much a reaction, but certainly a market bounce following the weakness we've seen recently. First day in a few that we are seeing green on your screens. The vol index is pulling back a little bit, so you are getting some adjustments as these markets and then pricing moves have reached fairly extreme levels. In fact, if you're just learning about this right now, this is really one of the worst performing markets globally and one of the cheapest markets globally as well, looking at PE here, Belle.
Yeah, for a variety of different factors. But as you say, we haven't really seen any sort of market reaction off these latest headlines so far. We'll leave that there, but we'll, of course, update with anything else that appears. In the meantime, some other corporate stories that we're tracking this morning, and shares of the chocolate maker Hershey have surged after Bloomberg reported that its bigger rival, Mondelez, is looking to buy it. A potential deal would create one of the world's biggest candy companies with combined sales of almost $50 billion. Sources say Mondelez has made a preliminary approach to Hershey, which has a value of more than $44 billion, including debt. TikTok has asked for a pause on the US law forcing either a sale or a ban of the app owned by China's ByteDance. A hold would give the Supreme Court or the incoming Trump administration time to decide on TikTok's future in America. The law is currently set to take effect on January 19, which is the day before Trump is inaugurated. Nippon Steel has released new details of its spending plans for mills owned by US Steel. It's part of a last-ditch effort to win backing from workers and politicians for its bid to buy the Pittsburgh-based steelmaker. After meeting with United Steelworkers leaders, the Japanese firm revealed new commitments on how previously announced $1.4 billion would be spent.
Okay, let's have a look at how this China market story is playing out on day two overall. So some of the cyclicals are doing very, very well. Initially, from Monday, going into the overnight electronic session, going into today, so things like copper, iron ore, steel, rebar futures, hot rolled coal, for example, and some of those steel derivatives are reflecting some of the recent policy pronouncements. I think you should be coming up on your screens as well. Things like iron ore prices, if we have them, can we just show them as well, please, as well. The equity market iteration of that is this, really on your screen. So a broad-based rally and quite significant in price. Iron ore in Dalian is up about 3%. That's in renminbi, of course, per metric ton. The other story that I think we did see some breaking news on that out of Japan right now is a company called Topcon. It's a medical equipment maker. It's up 10%, another 10% today. It's been up substantially recently. And we understand from sourcing is that the company is getting takeover offers, Belle. Yeah, the suitors include KKR, EQT, but it is really that sign that we're seeing that escalating buyout activity in Japan. So they held the first round of bids back in September. Yeah. It seems from our sources they're now narrowing those offers to include KKR and EQT. That's what our sources are telling us. But we're also hearing that the government-backed Japanese investment corp, or JIC, is also planning to submit an offer in the second round. Yeah, and to your point, right, the general thinking here is that some of the activist investors involved in this are looking at the company's market cap of about $1.3 billion, that's US dollars, as something of a conglomerate discount. So, yeah, there's a full write-up of this for our Bloomberg clients, of course, to read all about this going into the Japanese lunch break. Right, very quickly, let's have a look at the benchmarks, Chinese benchmarks, about an hour into the session here. So we've just pared back from the highs of the day on the Hang Seng Index. We were trading at one point above 21,000. The fact that we're trading at the 20,000 mark is good enough. Certainly, we've broken out of the recent range. CSI 300, just under 4,100 earlier on. We pared back a little bit as well from highs, still up 2%. Turnover, though, as you can see, bottom of your screens, has now topped 1 trillion renminbi in just the first 50, 60 minutes of the session. And I think we do have that graphic that shows you turnover, where that 1 trillion mark is. and also what the average is post the policy pivot, which is about 1.9. So given where we are and current momentum, we'll probably get to 1.9 by the end of the trading session ahead. Anyway, plenty more ahead. This is Bloomberg.
All right, it's 11:29 a.m. in Tokyo. Japanese traders, markets, they're just about to go into their lunch break this morning. And sort of the overriding sentiment in markets today is still coming down to what's happening in China and this pledge that we've seen more around stimulus. But still, we are seeing those sort of second-order effects in some markets. It doesn't seem to be benefiting Japan too much today, but we are just seeing a little bit of upside coming through.
Yeah, interesting the note coming out of our previous guest, Adarsh Sinha of BofA. So they have a non-consensus call on dollar yen. And in case you missed it, very interesting. The short version is we get to 160 by the end of next year. It's not going to be a straightforward line. And the thinking there has almost nothing to do with the BOJ and rate differentials. He thinks that Japanese households have been sitting on a lot of money, and that money, ever so slowly but steadily, has been flowing out of Japan into financial markets in the rest of the world, and that might lead to dollar weakness ahead. The question I had when he was talking about that is, at 160, do we need to talk about intervention, number one? And number two, do we need to talk about how currencies become politically sensitive again, given its level? And I think the last time we were at 160, didn't they intervene? They probably did, right?
We've seen a lot of different bouts of intervention, but yes, I mean...
I have a bit of brain fog today.
It weakens enough, and then also you get that risk of currency wars that start to come in, and how much would other governments or central banks also be willing to allow their own currencies to depreciate as well? But that's what we're seeing in terms of the broader markets today. You've got, again, Asian equities moving a bit higher, US futures fairly flat. There are, of course, other headwinds, though, that we're facing some of these markets, and that's not least some of the challenges between the US and China at this point.
Yeah, in fact, let's get to, a lot of the stories that are happening today are around the broader theme here. So let's start off with Nvidia, in case you missed that. So overnight, going into the US session on Monday, news broke that China has opened this investigation into the company over suspicions that a U.S. chipmaker broke anti-monopoly laws around this deal that took place back in 2020. Now, Beijing had given approval for the deal 4 years ago on condition that Nvidia not discriminate against Chinese companies. That a move is being seen as Beijing's latest response to escalating U.S. tech curbs. Now, China's trade conflict, and staying on theme, with the U.S. is now extending to the drones that have become a vital part of Ukraine's defense. Multiple sources say manufacturers in China recently began limiting sales to the U.S. and Europe of these key components used to build those unmanned aerial vehicles. Now, Western officials expect Beijing to enforce broader export restrictions on drone parts in the new year.
Meanwhile, Taiwan has put troops on high alert after saying China restricted airspace off its southeastern coast and sent naval vessels near the strait separating them. It's a potential sign that Beijing is preparing for military drills in the waterway. It follows Taiwanese President Lai Ching-te's recent visits to U.S. territories of Hawaii and Guam, which China has, of course, condemned. Let's get more on the outlook for U.S.-China relations now. Bring in Shirley Syaru and founder and chair of the Center for Asia-Pacific Resilience and Innovation, or Capri, also known as. Also with us is Harry Harding. He's University Chair Professor at National Chengchi University. And Harry, I'm going to start with you this morning. You do have experience and a background advising 5 U.S. administrations, right through from Carter, Reagan, Clinton, the Bushes as well. Talk to us about the U.S.-China relationship today and the direction that you think it's heading in.
Well, of course, it's not a very good relationship right now. The direction is probably to get worse unless Donald Trump is able to negotiate some kind of an agreement with the Chinese that would enable him to release the pressure a bit.
Shirley, just what's the iteration of that? So we know these relations aren't going to improve. It's how it expresses itself for companies to be able to plan around it. What do you think the next 4 years holds here?
I think things are, I agree with Harry, but things are getting very, very tough right now. As you see, the tit for tat is accelerating. And whether it's AI chips or drones, I think China has to show some force whenever Washington comes up with a new policy. With the third round, of course, of semiconductor policy, you can see that this tit for tat is accelerating in a way that is very difficult for society at large, the private sector, the civil society, everyone to basically catch up. And I think this is creating huge policy risk for everyone, from government to companies.
Do you see the way that this tit for tat is accelerating? Is this also what we should sort of expect? China is a rising economic power. We know the world order is changing from one that's been unipolar for so long to a multipolar world instead. Should we anticipate this?
I think we should. I think for two reasons. First of all, the Chinese have long said that China never responds to pressure. So they have this built-in kind of commitment that if someone threatens us or imposes sanctions or puts any kind of other pressure on us, we are not going to respond in the way that they want. And now they're also saying you can expect us to retaliate. But of course, tit for tat is a very cautious retaliation. It's not escalating. It's trying to say whatever you do, we will counter you in kind. So it does mean that China will respond negatively and try to, in a sense, punish people for pressuring it, but they're going to do so in a very calculated and deliberate way.
Harry, let me ask you a little bit about that too. There's an emerging view that Donald Trump might not actually be as hawkish on China than what it sounds like outside. Do you agree with that view?
I agree to it in a way. First of all, I think that Trump has always seen himself as a great deal maker. So what he threatens to do or actually does is usually the first round in a negotiation. And we know that he wants to have some kind of a deal with China that he can claim as a win for him. So I think that he is going to negotiate. Now, the question is, how will the Chinese respond to that? That's the way he started the first Trump administration, too, as you know, with the trade negotiations with Xi Jinping. They did reach an agreement. It wasn't a huge one, but he could claim we made some progress. But then the Chinese didn't really fulfill it. So I think that Trump will be looking, and the rest of us will be looking to see, can they reach a deal? But then will both sides actually live up to whatever they agreed to in that deal?
I guess it's also not just both sides. I mean, it's not just the US and China. Taiwan plays a really key role in this, and any sort of restrictions that are on place of Beijing and Chinese companies by necessity involves Taiwanese ones. And Capri as a foundation has a lot of chip makers that are on the board. Do you have any sense that the incoming Trump administration is involving Taiwanese companies in these sort of pre-negotiation discussions?
Well, I don't speak for any of the companies that we are involved in, but all of the private sector is very supportive of trying to navigate a way out of the unpredictable policy situation. And yes, everyone is working very closely, but within constraints that are incredibly difficult. For example, if Taiwan really needs to spend 5% or 10% of its GDP on defense, that's going to bust through the budget. The government budget, as of now, is already spending 19% of its budget on defense. So we have to really think, is Trump being serious about it? Another point that's really important is, as the world is trying to diversify and find secure supply chain, if the world were to diversify away from Taiwan, according to Bloomberg, it would cost $10 trillion. Now, who's going to pay for this? And if I could just use a very simple example, drones. If actually U.S. and China stop, Dazhang drones is Chinese-made drones that are over 50% of the U.S. commercial drones market. And the ones that will be hurt in the United States and the world are law enforcement, agriculture, and surveyors. And I think that, Taiwan trying to make drones with the United States is a good plan. But I think the whole end game is everyone needs to become more resilient with these policies, not less. And I think it's going to hurt a lot of people as the market diverts away from resources that may be necessary to do other more important investments.
Do costs go up of doing business? Because if costs in an industry like semiconductor chips goes up substantially, and that's in everything we use really in daily life, that other costs go up as well. It's a sense that you get from the people that you talk to that they're prepared to spend more? in the coming years?
The question is who's going to pay more? And I think, first of all, as you know, as the chips are onshoring in Japan, in Arizona, and in Germany, the cost is going up. And who is going to pay for this increased cost? For sure, conceptually, tariffs will raise prices for everyone. But in addition to that, there's going to be redistribution from some companies to other companies. Some parts of the supply chain will be slowly moving. But the long and short is it's very difficult to move the most advanced semiconductor chips away from Taiwan. And therefore, it is important to make the Taiwan Strait safe, because in the short term, there's no replacement. So it really raises the question, why antitrust on Nvidia right now? And again, a lot of it, I think, is policy staging, not necessarily actual business diversion.
And we've seen and heard from a lot of Taiwanese companies that they don't want to move their most advanced production manufacturing facilities off the island, essentially. But still, it seems like the direction for travel is that continued relationship between the US and Taiwan, and whether it's chips or whether it's drones. Harry, how do you think China is likely to take that expanded economic relationship?
With Taiwan?
Yeah.
Well, of course, they won't like it. And their whole goal is to try to isolate Taiwan from the rest of the world, both diplomatically and politically, and in terms of security and in terms of commerce, as much as they can. So I think it's a challenge to see how many countries can basically stand up to that pressure from China, how many will push back and say a business deal is a business deal. So we'll have to wait and see how much pressure they will put on those companies. We know they've been putting a lot of pressure on Taiwan this year, and suspending some of the tariff reductions that were agreed to under the Economic Cooperation Framework Agreement. They have been putting all kinds of sanctions on various imports from China, some things simple but very important to the Taiwanese economy, like pineapples. And so they will be, and they are threatening to put sanctions on American military equipment manufacturers that sell to Taiwan or provide in other ways. So, yes, there will be these kinds of tit-for-tat struggles and pressures as well.
The U.S. side is pressuring Taiwan, but so the Chinese side, but so is the United States. If you think about the export control and the sanctions on semiconductor, it's really hurting the private sector and hence the economic and overall resilience of Taiwan, which is important to keep the Taiwan Strait safe, deterrence. And so I think we've come to a really important point to look at the low-hanging fruit of diversification has been done. Taiwan, for 8 years, actually has now reduced the two-way trade between Taiwan and China from 40% to 28%. And foreign direct investment from Taiwan to China has dropped significantly. So now, today, for the first time, Taiwan invests 3 times more in the United States than in China, $9 billion versus 3. But now it's getting very, very difficult. Taiwan still has $200 billion out of $400 billion of investments in China, and those are very long-term investments and good business opportunity. So to ask the Taiwanese to diversify away from China faster and more than American companies seem to, for a lot of Taiwanese, to be unfair, and also undue burden on the Taiwanese to help America be resilient at Asians' cost, basically. Whether it's Taiwan, South Korea, or Japan, everyone feels the burden. So I think the pressure from both sides is increasing skepticism towards the United States, along with skepticism towards China, which was always there.
Okay, looks like we have something to discuss and to start on for Chapter 2 of this discussion. That's all we have time for now. Thank you so much to both of you. Shirley there, of course, Shirley, Syaru, Lin, a founder and chair at Capri, and Harry Harding, the university chair professor at the National Chengchi University. Okay, let's stay slightly on theme, and the common denominator is the Chinese story, and we're continuing to track the market reaction or the market's pricing around more of the pronouncements coming through out of Beijing yesterday, out of the Politburo. Chinese 10-year yield on your screens. So recently we took out 2%. We took out 1.9% this week. And we're now looking at calls coming through out of the sell side right now. Tianfeng, Zheshang Securities, and Standard Chartered Bank are some of the brokers here that are calling for the 10-year yield to drop to as low as 1.5% to 1.6% by the end of next year, to be more specific as far as the timeline goes. But it's quite a sizable drop that we are seeing today. We're down about 5 basis points on the Chinese 10-year yield. So the rally continues. in his world-beating CGB rallies. Plenty more ahead. This is Bloomberg.
Taking you to Seoul this morning and some of the headlines that have just been dropping. We've got local media reporting that the ruling party PPP is discussing President Yoon's exit in February or March of next year. We know that there has been these efforts around impeaching him or at least for Yoon to step down. And so that is the latest that we have on that front. But we're also getting reports that South Korea's top police officials have been banned from leaving the country. That's along with President Yoon after his botched imposition of martial law last week. Our reporter Sang-mi Chow joins us now. And Sang-mi, just bring us up to speed here. What's standing out to you right now as this story develops?
Yeah, there are a lot of moving parts here, so everything is changing all the time. And as we were speaking, the Defense Committee is grilling, and all the lawmakers are grilling these military personnel who were involved with the martial law order back in last Tuesday. But as you said, the People Power Party, the ruling party, has come up with some of the plans. A task force within the ruling party is discussing somewhat of an exit plan for President Yoon Suk-yeol, which they're floating the idea of having him leave around February or March next year. And that means within 60 days from him leaving, they will need to have the next presidential election. But this is, again, not confirmed yet. This is what we're hearing from local media. And just like you said, the president has been banned from traveling outside the country. This is the first time any president is experiencing such risk of flight within the country. And so we are following those developments very quickly. He's faced with treason charges from the police and prosecutors. And if he is found guilty, and this process could take months or even years, but if he is proven guilty, then he could actually go and face a life sentence or even death penalty, which is very unlikely in Korea, though.
Sang-mi, just to look at the market angle, I mean, today we're seeing a rebound in stocks. The currency's doing well. Corporate bonds, I think yields are also pushing down as well today, and they're tighter. What are markets looking ahead to?
Yeah, Kospi and Kosdaq are both up today for the first time after that 4 trading sessions. And we have been doing some calculation, and we saw that the past 4 trading sessions since the martial law was declared and quickly rescinded on Tuesday, we saw that the aggregate of the market value of the companies in those 2 benchmarks, Kospi and Kosdaq, have been wiped out $100 billion. But ever since then, we've seen, again, 2.4% gaining in Kospi, and Kosdaq is up close to 5% now. We're watching very carefully whether this gain can be sustained, as traders are cautioning against this volatility that we might potentially see further down the road this week and next week, because again, as I said, there are a lot of moving parts here, and this volatility, ups and downs, can come down very quickly, especially given that Kosdaq and Kospi, the Korean equities, have been one of the worst performing gauges in the world the past year.
Sang-mi Cha, our reporter in Seoul, for us on all the latest in politics and also in markets. Just ahead, there's one market event to look ahead to. That's the RBA. And as you look at that, we'll get you a preview of what to expect. We did also get some of the business sentiment indicators out of NAB earlier on. So we'll put everything together for you. Markets in Hong Kong and China are continuing to see some upside, as you can see on your screens, as with, of course, South Korea, as we just pointed out there.
I think the overall tone of the government's policy over the next 3 to 6 months continues to be ongoing support for the economy. Now, we've had that since late September, and frankly, we're still waiting for a lot more of the details. But I think the fact is, when you're looking at the global environment, it's getting more uncertain, getting more volatile. The fact that the Chinese equity market is still quite attractively valued, I think that does help to attract some investors to come back in.
We expect another 30 basis points of rate cuts, policy rate cuts from the PBOC. I know there's a lot of excitement around the Politburo statement around looser monetary policy, but there's not that much further that they can cut rates at this point. So, I mean, bond yields will move down in our view, but the big move is probably behind us.
Yeah, just some of our guests earlier on here on the China Show reacting to the signals out of Beijing for bolder stimulus. Certainly there's a lot bolder in messaging. Markets are running with that. We're still waiting for details, really. But do we get details? Further details this week is the question.
Well, I think it's also not this week. I mean, that sort of, although actually we've sort of been discussing President Xi's been someone who's not afraid to break the rules. Do we get a little bit more than we might expect maybe out of the Central Economic Work Conference? It certainly seems, and to Mark Cranfield's point at the top of the hour, that markets have done the best when the PBOC is speaking.
Yeah.
So they want to keep hearing from regulators and policymakers, what is the direction, where are we going, where is this money going to be directed, in what fashion, and that's certainly what people want to hear. But of course, how long we see this euphoria for depends, I guess, on what we get.
Yeah, and I think the point there was, I think, the first time in 14 years that they've actually changed the stance, or they've come back to that stance of looser policy. And 14 years ago, we don't really need to get into history, but we know what happened 14 years ago and why they necessitated needing to put monetary policy on the front. So they've talked about the shift in the policy stance. They've reiterated the commitment to stabilize both the property and the stock market, and hence why markets are doing this. In fact, some of your consumer stocks, if they do manage to unlock and stabilize the housing market, and if they also are able to unlock some of the sort of the gridlocks across local government spending, that leads to consumer spending, and that's the second derivative here.
I do think, though, it's when you sort of stack up that, yeah, you've got that pledge, they're going to do whatever it takes to forcefully lift consumption. But look at the inflation picture in China. We had the CPI figures out yesterday, right? Yeah. And it was at 0.2. It was less than what economists had been expecting. You've got PPI that's still in deflationary territory. I mean, they've got quite a lot of work ahead of them, really, to achieve that goal.
And yeah, and I think you're right. That might actually be part of the reason why, you know, people who were sitting on the sidelines yesterday in the bond markets looking to buy into the CGB rally were waiting for more details. I mean, they got the inflation print and then they got the policy pronouncement that things will remain loose moving forward. Well, this is also creating quite the perfect scenario and conditions for this listing today here in Hong Kong. And as you can see there, you can't make this up.
No, that's right. This is Mao Geping. It's making its debut today in Hong Kong. This is a Chinese cosmetics giant. You can think, I mean, at least from a pricing point, it's alongside Western counterparts like Shiseido in Japan, but NARS, for instance, surging today on its trading debut. This is the first time we've actually seen a homegrown cosmetics brand listing on the Hang Seng. So that is it for today's show. We will, of course, be hearing from Shirley, I believe, covering for Haslinder Amin. Insights is coming up just in the next few minutes as we await more details, of course, what's happening with Chinese equities into their lunch break soon. But we are seeing a picture of green across the screen.